What's going on, guys? Welcome back to the channel. Matthew Muniz here. The passions are family, fitness, and finance. Today, we're going to talk about my favorite investment strategy, which is through dividend ETFs or index funds, and how we can invest on these on a weekly or monthly basis, dollar cost average in, and then 10 to 15 years from now, live the dream. We're going to talk about why specifically dividend ETFs are the perfect investment for someone that still works a 9 to 5 and doesn't necessarily have the time to do the research needed in order to invest in individual stocks or cryptocurrencies or anything like that. So if you like collecting money, just relaxing at home or doing your favorite hobby, then smash the like button down below. Make sure you subscribe to the channel for weekly videos every Thursday. And we're going to get right into this video. So first things first, what exactly is an ETF? An ETF is an exchange-traded fund that is like a security that tracks an index or a group of assets that can be bought or sold just like a stock on a normal trading platform. So the great thing about ETFs is they offer all sorts of diversification to a portfolio with minimal effort. For someone that works 9 to 5 and doesn't have the time to do tons of research, ETFs or index funds can be a great option for someone to invest and take advantage of how the market's doing. However, the market does go down sometimes, but if we're following a dollar cost average strategy, we don't really care if it's down or up because we're going to continue to invest on a monthly basis. The benefit of dollar cost averaging is you're just putting money in, and whether the market is low or high, in the long run, going off precedent, the market's going to continue to rise, just like with our ETFs or our index funds. The great thing with the diversity is we get less volatility, so we aren't putting all of our money into one stock like Tesla. We're not just hoping that Tesla skyrockets to the moon, and if it does crash, hopefully it doesn't, then that doesn't matter either because we're going to have a bunch of other companies in our ETFs or in our index funds that help maintain the ETF's current value. So the best thing about the dividend ETFs is it makes it really easy. Since you're paid out dividends on a monthly or quarterly basis, depending on the ETF, you're getting paid for holding the ETF. You don't need to go into your original investment. You're not pulling any shares out. All you're doing is just collecting money, whether it's monthly or quarterly, based on your dividend yield. This is very similar to a savings account, except savings accounts offer extremely low interest rates. So if you keep your money in a savings account, you do have less volatility because your money's not going to go down. However, you're not really going to make any money either. At least with dividends, you can get an easy 3 to 4% with no issues at all. So in theory, when a dividend pays out, a stock or ETF is supposed to drop by that amount. However, that doesn't always happen. You may have an ETF such as SCHD or SPHD, both of my favorite. Both of them have actually had capital appreciation over the past 5 years, and they still pay out their dividend returns. SCHD is quarterly and SPHD is monthly. Another way to save time and effort with dividend ETFs is through DRIP, dividend reinvestment. One thing to remember though is even though DRIP allows you to automatically reinvest your dividends into the ETF that they came from, it does not benefit you in any way in terms of taxes. At the end of the year, you're still going to have to pay taxes on all of the dividends that you've made, unless somehow it was return of capital based on which ETFs you have. When it comes to taxes, there are qualified dividends, which are spectacular, especially in retirement. If you are retired and you have no income and all you're collecting is dividends, let's just say you have $1 million investment, you have a 4% return, which is $40,000 a year. Right now, those $40,000 in dividends would be completely tax-free if you're an individual filing your taxes. So that's almost equivalent to making $60,000 if you had to pay taxes on it. Certain dividends are only qualified dividends based on how long the holdings within the ETF have been there. So you're going to have to do your research to figure out if your dividends are going to be qualified dividends or not. If you want more information on specific ETFs, you can look at the companies where you're investing, such as Fidelity, Robinhood, Webull. I do have a link down in the description for Robinhood. It's a very easy app to use. If you use my link, you get a free stock to start off your investments. So when it comes to actual strategy with dividend ETFs, it's definitely not a get-rich-quick scheme. There's many other ways where you can put your money and hopefully double or triple your money in a really short time. However, with those ways, there's a lot more risk involved. With dividend investing, all you're doing is you're staying consistent on that monthly basis. You're investing into whatever ETFs you like, and over time, whenever you decide, you can start taking the dividends for yourself, or you can continue to reinvest them and grow your nest egg. Once you're at your goal, you can use those dividends to inflate your lifestyle a little, maybe use that money to pay for a vacation. But either way, You don't need to touch any of your shares. All you do is you have your nest egg, you collect money on that monthly or quarterly basis, and you can choose, do I want to reinvest this into more shares and get more passive income? Or do I want to use this to take my wife out to dinner, take my family on vacation, whatever it is that fits your family's needs. Now, when it comes to my personal strategy, this is completely separate from my actual retirement. I still have a 401k that is super close to being maxed out per year. I have a Roth IRA as well. And then I have my brokerage where I'm investing in dividend ETFs. My idea is I'm going to invest for the next 10 years on a monthly basis, a little bit over $1,000 a month. And at the end of those 10 years, I'll be $200,000 to $300,000. And if I'm getting a 4% return on that in just dividends, or even 3%, then I can guarantee myself around $600 to $900 a month in passive income. So 10 years from now, I'll be able to use that money towards vacations or whatever else it is that my family needs. Or potentially, maybe it'll help me retire even earlier. We'll have to play things by ear. Now, dividend ETFs are not the only type of ETF you can invest in. You can invest in growth ETFs, and some people will actually say that that's a better investment than dividend ETFs. However, I don't necessarily agree with that. If you were able to invest in growth for the next 10 to 15 years, and then immediately cash it all out and transition it over into a dividend ETF, then for my personal goal, that would work well. However, there's a lot of tax implications with doing that. So I prefer to have a portion of my portfolio to growth ETFs and another portion of my portfolio to dividend ETFs. Therefore, I have high capital appreciation, and then I have my consistent dividends on a monthly basis or quarterly. When it comes time for me to use that money, I'm not going to cash out all the growth and transfer it over. I'm just going to try to utilize both simultaneously. So in summary, dividend ETFs or ETFs in general are a great investment strategy to add in addition to your actual retirement strategy or just in general. The benefits of the ETF include diversification, minimal effort, lower volatility than individual stocks, depending on the ETF that you choose. However, you do need to remember that with the dividends, you're going to have to pay taxes at the end of the year. So all in all, if you're like me and you're working consistently, if you can afford to take a portion of your income and put it into a dividend ETF on a consistent basis, go ahead and dollar cost average in, then in the future, you could really set yourself up for success. The last thing to remember is the younger you are, the better opportunity you have. The more time you have to take advantage of compound interest means the more your money is going to grow. So it doesn't matter if you have $10,000 today or $10. If you start averaging in on that weekly basis, you're setting yourself up for a brighter future. Now, if you enjoyed this video, let me know in the comments down below what you want to see a video on next. I think I'm leaning towards starting to do individual ETFs, such as a video on SPHD, perhaps a video on SCHD. If you haven't already, make sure to hit the like button, subscribe, and I hope to see you in the next video. Thank you so much. Take care.